Jonathan, welcome to the show.
Hey, thanks for having me, man.
Yeah, I appreciate you taking the time. And with Vertex Ventures, with people who aren't familiar, where are you investing? What's the focus of Vertex? Tell us more about that.
Yeah, so we started Vertex Ventures in the US about 7 years ago. We are early stage investors, which I think is a little bit of a moving target these days. We approach investing really given our backgrounds as founders, as it's these are long journeys and it's a full contact sport. So we elected to be very focused with how we invest. So we make about 3 to 5 investments a year across the team, the partnership. There's four investors and a couple of people in operating roles, and we in particular focus on B2B software markets. And then within B2B software, there's things we like and things we don't like. You kind of think of it like a hot or not list. We spend a lot of time, about half our time, in horizontal infrastructure. So cloud services, developer tools, data and data related services, essentially all like primitives that you might then use to build some vertical SaaS applications in HR or finance or other B2B applications. But we really focus on those three horizontal layers, and then spend a little bit of time in those in different verticals. And those verticals change about every 18 months. So like I'm kind of coming off spending time in construction and real estate, and now spending more time actually thinking about like infrastructure as a service and what's going to be the next big thing to happen there.
With that, when you launched, so in 2015, then with Vertex Ventures US, with that, is it a matter of like you knew right away what the focus was going to be in terms of where you launched, and it's evolved since then, or has it kind of stayed the same? I'm just kind of curious of how that's evolved since 2015, the
Yeah,
focus of the fund.
yeah, exactly. Yeah, great question, Justin. I'd say when we started initially, it was very infrastructure focused. Probably 80, 90% of the things that we evaluated and entrepreneurs we partnered with, and that was 7 years ago. And so as we've evolved, I think it's partially as the value has shifted out of infrastructure into more kind of full stack applications, than just sort of purely horizontal software. But we still see tremendous like opportunities really in building the tools that are building the foundations of the internet. For example, recent investment that was just announced, I think in the last week, we co-led the seed round of a company called Orkez with Battery Ventures. Orkez is really a company that was founded by former Netflix engineers, and they're commercializing Netflix Conductor, which is like an orchestration system for microservices, right? So if you think about e-commerce, or pretty much any business these days is constructed of dozens to hundreds of microservices that this is a conductor, and Orcas are tools to then manage and orchestrate all of the sort of business logic that runs on top of that. So very horizontal, applies to lots of different businesses, based in open source, but now offering commercial software support and features up above and beyond the open source.
With the last, you've been in this space a while, a decade or more. With this time, I mean, we've seen the changes of this industry in the last decade. I'm curious for your perspective, like what have been maybe some of the biggest changes you've seen, since you started in venture to now in 2022. And me being at Vitalize, we see these changes over time, even the last year or two. I'm just curious from your perspective, with a longer time horizon, what have you kind of notice around the changes of venture and into what we have today in the venture space?
Yeah, that's interesting, man. Well, I have a lot of gray hair, so I've sort of been in and around venture, and I've sort of my career is tacked between operating and investing for 25 years. I started a venture fund in 1999, which was a great time or a terrible time to be a venture investor. I was at Global Crossing at the time. For us, it worked out pretty well, but yeah, sort of been more seriously investing for the last 7, 8 years as a venture investor versus also an angel investor, which I think is a whole other thing we could probably spend a whole
Of
20, 30 minutes talking about, right?
course.
In terms of companies, I mean, I think the biggest shift is it used to be you raise $5 to $10 million and you take 80% of that money and you invest in infrastructure to like pop up your website, your e-commerce shop, your SaaS application, whatever the case is. Obviously, that's gone away thanks to the advent of cloud computing. Being able to sort of buy on a credit card and grow and scale. I think also the other obvious one is that the internet has grown dramatically. When I started, there was probably when I started, the internet like was just the NSF net. But when I started more seriously, I was like 17. when I started my first company, there was probably 5 million people on the internet, growing to 50 million. And now there's, whatever, 5 billion people on the internet, plus or minus a billion, depending on the day of the week. Um, but I think as it relates to venture, that deal making pace, especially in the last, call it 5 years, has really picked up. Where I feel like, when I started my first company, there was a sort of romance to raising venture capital and like building that relationship. And now it's like, no, it's velocity. And it's like, who's going to cut me a check first? And can I get, money at lunch or this or that? Um, and as both a founder and investor, it kind of saddens me because I think that that's very transactional when, these are often, or in most cases, I would even say, 8 to 10 year, if not longer, journeys that we go on with founders, or as a founder with our investors. And it really helps to know the people, I think, before you get in business with them. And then, I think writ large, if we just sort of look at investment volume, deal volume is up, 2x year on year just in the last 2 years. But that is actually, it's actually been relatively stable when you zoom back out, sort of looking at the 5 to 7 year horizon in terms of deal volume. But dollars has risen very dramatically, right? So the amount of money that companies are able to raise and then invest in talent and marketing and branding and turning venture dollars into Google dollars, right? Sort of spending on ads, like that has really continues to rise steadily every year.
With that, to that point then, Jonathan, you mentioned the volume of deals, it is insane how many deals. I mean, I talked to some firms where they're 30, 40, 50, 60 in a year. You're just like, that's insane. For you staying so focused in, you mentioned 3 to 5 deals a year, maybe. What helps you on that, staying on that path, even with the velocity of deals happening around you, knowing you're trying to just pick those best 3 to 5? What gives you that conviction or helps you stick to that, not change your strategy? Like, I'm just curious on how you've handled that so far, Jonathan.
Man, well, I'll be honest that there's not a night that I don't go to sleep, or there's not a morning I don't wake up when I don't have FOMO, or for something that I missed, or that we didn't get to do. Um, and sometimes that FOMO turns into JOMO, the joy of missing out. But look, I would say in reality, the press gets to cover maybe the top 2% of or 5% of venture deals that get done and get written about. The reality is there's way more deals that never get touched. And again, if we look at sort of the recent history of venture capital, the last decade or two, the average uh, um, sorry, if we look at venture capital over the last decade or two in terms of companies that drive returns, it's generally 10% win rate is how we think about it as investors. That 10% of the companies will generate significant returns and pay for the other 90% of investments in the fund. One of the things I think that we like about being concentrated and focused is it allows us to, kind of put some blinders on and focus on a few companies, a few markets, a few founders, be more helpful than maybe the average, and introduce our networks and help recruit, do all those types of things. But then the results they're still early for us because we're a very young fund. But so far we have a 20% win rate, and so kind of double the median or the average there. Actually, I don't remember if it's median or average, but let's just say one or the other.
Yeah.
In seed and early stage funds. So that's kind of what I think keeps us going and keeps us wanting to be focused and concentrated, and also just quite frankly, Justin, just because there's only so many hours in the day, and like I can only spread myself and my partners we can only spread ourselves so much that I admire the people who've built index funds, especially at early stage, not index ventures, but index funds of venture.
Yeah.
And they're able to produce great returns, and they have I think they end up investing in a lot of great companies. But it's a very different style of investing, and we work with many of them. They're on the same cap table as we are, and we're apples to their oranges in terms of the services and value that we provide to founders.
With that too, and just talking more about the strategy behind it. I know being in the conversations with our team about our strategy at Vitalize, we're always thinking about what route to go with it. There's different people doing kind of interesting new things in terms of venture and the space in general. How concentrated do you want to be in your portfolio or not? With you, is it something that in that fund, obviously when you raise a fund, you have the strategy laid out, LPA, all that stuff. But we look at kind of the future and everything as well. Like, how do you think about that in terms of adjusting strategy, things you might want to change for next time? Is that just something like, oh, we'll take note and not worry about that because that's a later problem? Like, I'm just curious for your perspective on the strategy of your fund as well on that.
Yeah, I mean, we're going through it right now in terms of like we're raising our third fund. We're in the process of raising it. We started investing it on September 1st, and the market's changed since the last fund we raised, which was Fund Two. We closed that at the beginning of 2019, invested it from January 2019 to September 21, and I would say that we actually have this phrase in our deck, which is we're keeping consistent to our strategy. We've been consistently deploying capital. Our first fund, we probably deployed a little bit too slowly. It took us about 3.5 years to invest that fund that we started in 2015, where most of our peers were sort of on a 2.5 year investment cycle. But our LPs, many of them thanked us for that because they're like, well, all these other folks came back early for re-ups and bigger funds, and you guys didn't. But where that's hurt us is because of the longer deployment time, returns are taking longer to materialize, and obviously IRR has a dampening effect there. But as we think about Fund 3, it is sort of largely sticking to our strategy, sticking to being early. We think about 3 phases of investing or a company that we would invest in. The first phase is kind of inception or pre-seed investing. It's an idea. We can explain the dream to each other of working with that founder in the market. And, we'll invest in today's market $500K to $2 million, roughly speaking, at that stage. And maybe we're doing it alone, maybe we're doing it with someone else. That's a separate calculus. And then the second type of investments we make are seed investments, where we're basically looking for like leading indicators, some amount of product market fit, but generally no revenue. And so that's like kind of a $2 to $4 million investment from us. Again, could be by ourselves or with syndicates. Most of the investments we make are in syndicates with other investors, both angels and other institutions. And then the third category is basically early revenue. That could be Series A, it could be Series B. I think those round labels are changing a lot. That looks like a 5 to 10 or even $5 to $12 million investment from us. Again, generally part of a syndicate, so that might be a $20 or $30 million round that we're leading or co-leading or participating in. But and the idea there is that for inception companies, we generally don't reserve to follow on, so we're not reserving capital. But how we think about kind of the engagement with founders is that at seed and Series A and beyond, we're reserving dollar for dollar to follow on into those companies, and that's what So then our model is that gives us roughly 25 investments out of a $200 million fund. And, again, hopefully we can maintain the sort of 20% win rate. So if we start with 25, hopefully we have 5 that, generate material returns, for us and our investors and all the founders that we work with. And I think we look at it in through the lens. What am I trying to say? We look at this through the lens of something that called the Soros ratio, which is sort of the ratio of dollars your winners make versus dollars your losers or the companies that don't make it provide, right? And that ratio between the two can be constant, and it generally is in the case of venture, concentrated in terms of there's a few winners that really break out that then drag up the whole portfolio. That's less common in B2B investing, where we focus, in that because there's so many exits that happen in B2B between $500 million and $1 billion, at least in 2020, leading up to 2021, right? We'll see what the current market conditions and multiples do. But again, for seed funds, seed investors, and even Series A investors, having multiple exits at the sort of $500 million to $1 billion mark, like those are meaningful returns for founders, for employees, and for funds of our size. That doesn't necessarily work for people on sort of multi-billion-dollar platforms, right? They really need to play for the $10 billion style outcome. And again, those are companies that maybe get a lot of press, right?
It's going to be interesting to see that, to that point. You see these massive funds making like $300 or $400 million seed funds now, coming down from that. But then also what you're seeing is these operator investors who are launching these $10 million funds. Most of them are doing $10 million funds. Obviously, the regulations kind of makes it easier to do it that way. And then you're seeing them obviously with the returns they need. They don't need, like your point, they don't need $10 billion exits. They can be fine with a couple $100 million exits based on the fund size and the actual portfolio, how that returns. it's going to be 5x, 10x, whatever. It'll be great. But it's obviously a small fund. So a lot of different strategies with that. With the follow on too. So you mentioned not in the early years, but you will do one for one in kind of the middle round. Do you have like ownership targets as well with that you're trying to maintain? I know we've kind of gone back and forth at Vitalize on that as well. I'm just curious on like your thoughts on that too.
Yeah, I guess I'm curious to hear how do you guys think about it at Vitalize in terms of like what do you think about it in terms of initial ownership or exit ownership?
Yeah, well, I'll say for some of the companies, let's put this way, for some of the companies we have that have gone really big, we obviously would love to have more of an ownership in those companies. And just with how it worked out, it may only be a couple percentage, but obviously it's huge for us with our first fund being 16 million. I think we had been playing with in this next fund will raise at some point a more so 10% ownership stake, but that really depends on obviously the company. And then, we like to reserve, I think it's one for two in terms of follow on, not necessarily doing one for one, but like half in terms of follow on. But that's all something that can be fluid in some ways until you actually finalize the raise of the fund and obviously raise the fund itself. So we would love to have that ownership target initial, at least, not necessarily keeping that, but obviously just having a higher percentage as we move forward through the rounds. But no right answer. But I'm always curious as to what people do.
Yeah, no, I think that's it's great to have that I think mentality, right? I think one of the things with these models is we sort of start with that model. It's obviously what we sell, what we sign up for as the GPs and as the investors, and we sell it to the people who our clients, right, are the people who've invested in us. Um, but the market is a fluid one in terms of there's competition at every stage and at every layer of the stack. And one of the unique things I think about venture is that while pretty much everyone is a competitor, everyone's also a collaborator, right? We have to
Yeah.
figure out how to work with each other. And so I think we have seen, you know, average ownership decrease over time. Back when I was a wee little boy in venture, it was very common for if two firms were leading the Series A or the first round, today we could probably call that a seed, that they would get 30%, 15 each, or even 35%, right? Significant ownership. And today, I think at least when founders come into Vertex and we see that they've already diluted 30 or 35% for a small seed, maybe $5 million or less, that makes it tough for us. And we think for then follow-on investors because the founders have given up so much equity away from themselves, right? That they may not have the incentives to really kind of stick around and stick to the business long term. So, to give you, because you were kind to share some of your data, how we think about it is in terms of those three buckets of investing. Inception, we're looking for kind of 5 to 10%. These are big ranges, right? 5 to 10%. At seed, it's more like 12 to 17%. And the big swing there is, are we doing it solo, maybe with a couple of operators or angels, or are we going to partner with another fund and kind of two funds, do the seed round? And then at Series A or even later, potentially, it's kind of 10 to 15%, which is overlapping a little bit. But obviously, the dollars at work are generally 2x
Yeah.
for that same ownership. And if I look at our portfolio ownership over time, Fund One, the median initial ownership of that fund was probably 19%. And then, as companies raise follow-on rounds, the best companies generally, there's so much capital that gets thrown at them that they get oversubscribed, and that means inside investors have to kind of cut back our ownership a little bit. And I think not every founder realizes that on day one, but it becomes a fact of life, and that founder or that CEO has to be the one to make those hard calls and say, well, I've got this new shiny investor and they want to own X, and that means, sorry, Jonathan, even though you've been by my side for 4 years, I need you to take 10% less or 20% less in your ownership, right? And that's always a tough conversation between investors and founders.
To that point, with your experience and you're on a number of boards with Vertex, and you've been, as you said, in the industry for a while. Those hard conversations with founders. Tell me more about how you approach those. I know it's a case by case basis; it's different, but that's something especially if you're on a board with so many different companies. How do you approach those? What's been helpful for you, at least for other investors out there who are on boards or getting on board soon? And I'm curious about that whole process too.
You mean in terms of like kind of like how to interact with founders and like mentoring, coaching, or
Yeah, yeah, yeah. I would love to hear your perspective around how that's gone for you, at least.
got it? Um, it's a mixed bag. It's a mixed bag.
Of course.
So I think one of my partners, and yeah, one of my partners, Insik, who started the fund together, describes himself as the prototypical Asian dad, and he's also Asian, so that works. In terms of how he coaches and mentors founders, I don't have either of those things. Like, we don't have kids, and obviously different background. So I would say that I have found the founder investor kind of relationship and matchmaking. It's a little bit like dating at the beginning. We're both trying to figure each other out. Do we want to work together? Can we work together? Do we have common interests, diverse interests, all of those types of things? And in each interaction and in each situation, I try to bring a different perspective. And it may not be right. And I always preface it with, look, I'm probably not right, but I just want to be somebody who's going to question things differently, for you and for everyone else who's maybe on the Zoom or in the call or around the table at the company. And I think a lot of that has been informed by managing thousands of people over my career arc. Where management is similar. It's one to one. It's everyone is a snowflake and needs a little bit kind of different treatment and style. But if we all sign up and agree on a common set of goals, a common set of objectives, then we can kind of look at that and measure ourselves against those goals and objectives and how we're progressing against them. And I think one of the most important things that a venture investor brings to especially a young company and young founding team, in the sense of they're early in their journey, not necessarily age young, is that horizontal perspective, that market perspective. Because founders, and we've been there, right? Like, we're so consumed with growing and building our company. That's all we think about night and day, 7 days a week. But one of the cool things about being a VC is we get to look across dozens of companies, and some people look across hundreds of companies to understand this growth rate, that growth rate, this sales tactic, this marketing tactic, this hiring tactic, and bring all of that back to bear, in terms of providing a tapestry or a panel of data for founders. And so I found that being able to sort of bring that objective type of data to discussions has been very, very productive. And especially, as I said, at sort of the early stages, but then also, like, as a company grows to having hundreds of employees, not all the time, but in most cases, at least in the boards that I'm on, that's the largest number of people the founders ever had to manage, right? And so they're having to manage and hire VPs, managers of managers, and all of those types of people for the first time. And having gone through that several times in my career, I've built up some bumps and bruises and some muscle memory on what works and what doesn't work.
It's so much to be said for having that experience, that broad experience, especially as a VC. Just like you said, you're seeing so many companies constantly, and obviously you're passing on a ton of them, especially for investing 3 to 5 deals, per year. And to have that experience as a VC, for then build on that compounding year after year after year, how many deals you've seen, just to have some perspective for founders, like that, to me, is so valuable. And I know founders have mentioned that same thing in different ways. People have different perspectives. They have multiple investors. They can look at different angles from that as well. I know we're almost out of time. I'm just curious, real quick, angel investing. I know you brought that up quickly. It could have been a whole conversation, but just take me through that side of things a little bit with you in the past, how that's kind of affected you as an investor. I know I talked to Leo Polovitz from SUSE Ventures. He still angel invests, actually, because he doesn't do that many deals out of SUSE, but he does a lot of angel investing to get that muscle memory. For you, where does that fit in terms of angel investing?
Well, so for me, I personally found angel investing. Well, let me back up. Before I even had the capital to angel invest, I invested my time, and it was so I became an advisor to a couple dozen companies, names you'd recognize today, like Dropbox or Box or YouTube, and then the prior generation of companies before then, because I didn't have the balance sheet to even write a $10,000 check, much less $100,000 check, for those companies at the earliest stages. And I found that actually kind of advising, like, it was a great way of getting to know a bunch of people, kind of testing the
Yeah.
waters. And I was also naturally, then I was on their side because I wasn't this big, bad or good investor. I was, a common shareholder, all of those types of, with all of the same elements as the rest of the employees and the founders of the company. But that's also what led me to become a VC. I saw, the opportunity and the upside, and I saw what that, founders, even the best founders, end up leaving early investors behind as, investors with 10 million, 100 million or more invest in the company, like they naturally start to spend time with those folks as companies grow and scale. And having been an operator, having been a founder, and then an investor or advisor, like I was like, oh, I want to have that full life cycle, that breadth. But I also want to start at early stages, right? Very early. And at Vertex, we like to get involved early. We're often the first check. We like to be, the water boys, the guides, the mentors, the Sherpas, whatever descriptor you like, for founders, and really help them kind of get the fundamentals right early. And we think that makes us kind of smart money investors versus people that are, more focused on the metrics, on growth, and on, behaviors and things like that. And so personally, where I've now started angel investing again is in backing friends and colleagues that are building their own venture funds that are, I think, doing, not the same things that I do, because I've got a lot of my own net worth tied up in Vertex and in a couple other
Yep.
things, but in helping a fund start helping a friend start a fund that's investing at the intersection of bio and technology, or in new types of materials, or in D2C consumer brands, things that I know nothing about because I'm interested to learn about them. And then from a capital allocation standpoint, it's giving me that kind of angel investing experience. And then honestly, the last part is being a GP is, I would argue, just as lonely, maybe even lonelier than being a CEO of a company. You really don't get to compare notes with people because, as we've talked about, right, we're all competing, but we're also all collaborating. And so to
Yeah.
have those connections and the relationships with people where I've invested in their funds, they've in turn invested in my fund, it feels pretty good, right, to be able to work together, work with people in that fashion.
Jonathan, I know we're out of time. Where's the best place for founders to go to reach out to you guys?
Yeah, the best place is definitely vertexventures.com, or shoot me an email. My email is pretty easy. It's jh@vertexventures.com.
Awesome. Thank you so much for your time today. I really appreciate it.
My pleasure. Thanks so much for having me.